Ladies and gentlemen, what if the biggest gold rally of this decade doesn't begin because of inflation, but because of a decision made inside the U.S. Treasury? What if the headlines everyone is watching are missing the real story unfolding behind the scenes? Today, we're breaking down why Trump's latest Treasury strategy has precious metals investors on high alert, why central banks may be paying close attention, and whether gold is quietly preparing for its next explosive move. Stay with me, because what happens next could reshape how investors think about wealth preservation for years to come. The financial markets often react to what is obvious. A strong jobs report moves the dollar. A surprise inflation number moves bond yields. A central bank decision sends stocks and commodities in different directions. But history shows that the biggest moves in gold rarely begin with what everyone is watching. They often begin with structural shifts that develop quietly beneath the surface, long before the headlines recognize what is happening. That is why any major change in Treasury strategy deserves careful attention. It is not simply about government borrowing. It is not just about interest payments or debt auctions. It is about confidence. The Treasury market sits at the center of the global financial system. It provides the benchmark against which nearly every other asset is valued. When confidence in that system strengthens, investors tend to favor financial assets. When confidence begins to weaken, even gradually, capital starts looking for alternatives that cannot be created with a policy decision or expanded with the stroke of a keyboard. Gold has occupied that role for thousands of years. The conversation should never begin with price. Price is the result. The more important question is, what forces are pushing investors toward or away from real assets? Treasury policy has the power to influence those forces in ways that are often underestimated. Consider the scale of government borrowing today. Every year brings new debt that must be financed, while older debt reaches maturity and requires refinancing. If borrowing costs remain elevated, interest expenses consume a larger share of government resources. That creates difficult choices. Raise taxes, reduce spending, borrow even more. None of those choices is painless, and markets know it. Investors are constantly evaluating whether current policies improve long-term stability or simply postpone larger problems. The answer affects everything from bond demand to currency confidence. Gold becomes relevant because it carries no liability. It is not dependent on a government's promise to repay. It is not someone else's debt. In periods where questions begin to emerge about fiscal sustainability, that distinction becomes increasingly valuable. Markets often assume that government debt can continue expanding indefinitely without consequences. History offers a more complicated picture. Every nation eventually reaches a point where investors demand greater compensation for lending money, or they begin seeking protection outside the traditional financial system. That shift rarely happens overnight. It develops through a series of seemingly unrelated events until confidence reaches a tipping point. Treasury decisions can accelerate or delay that process. If new borrowing expands faster than economic growth, investors naturally begin asking whether future obligations can be managed without significant currency depreciation or prolonged financial repression. Those are not emotional questions. They are mathematical questions. Numbers eventually command attention. This is one reason experienced precious metals investors spend less time predicting next month's price movement and more time studying long-term financial trends. Gold is not simply responding to daily news. It is responding to changes in confidence that may unfold over many years. Another important factor is liquidity. Treasury securities have long been considered among the most liquid financial instruments in the world. But maintaining that liquidity depends upon strong and consistent demand from both domestic and international investors. If demand weakens while borrowing requirements continue increasing, policymakers face increasingly difficult decisions about attracting buyers. Higher yields may attract capital temporarily, but they also increase borrowing costs. Lower yields can reduce financing pressure, but they may discourage investors seeking competitive returns. Every policy choice creates trade-offs. Gold does not compete directly with Treasury securities because it generates income. Instead, it competes as a store of value during periods when confidence in financial assets begins to erode. That distinction is critical. Investors are not choosing between identical assets. They are balancing security against purchasing power. Global markets recognize this relationship. Large institutional investors constantly monitor fiscal trends because they understand that confidence changes gradually before it changes dramatically. Pension funds, sovereign wealth funds, family offices, and central banks all examine long-term risks that extend well beyond quarterly earnings reports. That is why seemingly technical Treasury decisions can eventually ripple through currency markets, bond markets, equity markets, and precious metals simultaneously. It is also important to remember that markets rarely move in straight lines. Even if the long-term environment becomes increasingly supportive for gold, there will still be corrections. There will still be periods where optimism returns to financial markets and gold temporarily loses momentum. Those pullbacks should not automatically be interpreted as evidence that the broader trend has ended. Long-term investors understand the difference between volatility and direction. The world's financial system has become increasingly dependent on expanding credit. Credit supports consumption, it supports investment, it supports government spending, but every expansion of credit eventually requires greater confidence that future obligations can be honored without undermining the purchasing power of the currency itself. That confidence cannot be assumed forever. Gold has survived every monetary experiment because it operates outside political cycles. Governments change, policies change, economic theories change. Gold remains the same asset it has always been. It carries no default risk. It cannot be printed. It cannot be created by legislative approval or central bank policy. For investors, the real question is not whether Treasury policy alone determines the future of gold. It does not. Gold responds to a wide combination of fiscal policy, monetary conditions, global demand, geopolitical uncertainty, and investor psychology. But Treasury strategy influences one of the most important foundations of that equation: confidence in the financial system itself. When confidence strengthens, financial assets often outperform. When confidence weakens, hard assets begin attracting attention. Understanding where that balance is moving is far more valuable than reacting to daily price swings. That is why seasoned precious metals investors continue watching the broader financial landscape instead of chasing headlines. They recognize that major bull markets are built on structural changes, not emotional excitement. Treasury policy may appear technical to many observers, but beneath those technical discussions lies a much larger question about debt, confidence, and the long-term stability of the global monetary system. And whenever those questions become more difficult to answer, history suggests that gold rarely remains on the sidelines for very long. Financial markets often appear to move on headlines, but the largest pools of capital rarely make decisions based on a single news cycle. Global investors and central banks operate with a much longer time horizon. They are less concerned with tomorrow's market volatility and more focused on preserving purchasing power, managing long-term risk, and maintaining confidence in the financial system. That is why major shifts in U.S. fiscal and monetary policy receive extraordinary attention around the world. The United States remains the issuer of the world's primary reserve currency, and its treasury market serves as the foundation of global finance. Government bonds are widely held as reserve assets, used as collateral in financial transactions, and viewed as a benchmark for pricing countless other investments. Because of this central role, any meaningful change in Treasury strategy has consequences that extend well beyond American borders. For foreign governments, central banks, and institutional investors, the key question is not simply whether a policy change affects economic growth. The larger concern is whether it strengthens or weakens confidence in the long-term stability of the financial system. Confidence is one of the most valuable assets any monetary system possesses. Once confidence begins to erode, capital naturally starts looking for alternatives that can preserve value through periods of uncertainty. This explains why central banks around the world have steadily increased their attention to physical gold in recent years. Gold is unique because it is not tied to the financial obligations of another country. It carries no credit risk, no counterparty risk, and no dependence on the fiscal decisions of any government. In an environment where sovereign debt continues to expand globally, that characteristic becomes increasingly attractive. The accumulation of gold by central banks should not be viewed as a short-term trading strategy. These institutions are responsible for protecting national reserves over decades, not months. Their objective is stability, diversification, and resilience. When reserve managers increase their exposure to gold, they are often responding to structural concerns rather than temporary market fluctuations. Large institutional investors think in a similar way. Pension funds, sovereign wealth funds, insurance companies, and family offices evaluate macroeconomic trends that may unfold over many years. They recognize that financial systems evolve gradually, debt levels rise over time, interest burdens accumulate, Currency values shift. Political priorities change. The investment decisions made today are often based on expectations of where those trends may lead several years into the future. One of the most important considerations is diversification. Investors who manage substantial portfolios understand that concentrating entirely in one asset class or one currency creates unnecessary risk. Diversification is not about predicting disaster. It is about preparing for multiple possible outcomes. Gold has historically played a role within diversified portfolios because its performance has often differed from traditional financial assets during periods of economic stress. Another reason global investors monitor Treasury developments closely is the relationship between government borrowing and long-term interest rates. If borrowing requirements continue expanding, markets must absorb an increasing supply of government debt. The willingness of investors to purchase that debt influences borrowing costs, financial conditions, and ultimately economic activity. Even subtle shifts in demand can have significant implications for global capital markets. Foreign governments also face strategic decisions regarding reserve management. Holding reserves in a single currency provides liquidity and convenience, but it also creates concentration risk. As the global economy becomes increasingly multipolar, reserve managers may seek greater balance across different asset classes. Gold offers one method of reducing dependence on any individual nation's financial policies while maintaining an internationally recognized reserve asset. This process does not occur overnight. Reserve allocation changes are typically gradual, deliberate, and carefully planned. However, gradual changes can produce meaningful long-term effects when implemented by institutions managing hundreds of billions or even trillions of dollars. Market psychology also deserves attention. Investors often underestimate how quickly sentiment can change once confidence begins shifting. Financial markets tend to price stability until evidence suggests otherwise. When uncertainty increases, portfolio managers frequently reassess risk exposure, leading to adjustments that reinforce broader market trends. Gold benefits from this dynamic because it has maintained its reputation as a store of value across centuries of changing political systems, currencies, and economic cycles. While its price experiences periods of volatility, its fundamental role has remained remarkably consistent. It serves as financial insurance rather than a promise of constant appreciation. This distinction is essential. Gold is not acquired solely because investors expect immediate gains. It is often accumulated because uncertainty itself has value in portfolio construction. Insurance is rarely appreciated until it becomes necessary, and the same principle often applies to precious metals. Global investors are also aware that fiscal challenges are not unique to any single nation. Many developed economies face rising debt levels, demographic pressures, and increasing government obligations. These common challenges encourage institutions to examine assets that exist outside the traditional credit-based financial system. The interconnected nature of today's financial markets means that developments in one major economy quickly influence conditions elsewhere. Currency markets, bond markets, commodity markets, and equity markets all interact continuously. A policy adjustment affecting treasury markets may ultimately influence exchange rates, capital flows, inflation expectations, and investor behavior across multiple continents. For this reason, sophisticated investors spend considerable effort studying long-term structural trends rather than reacting to daily headlines. They understand that sustainable investment success depends on identifying gradual changes before they become obvious to the broader market. Gold remains part of that discussion because it represents permanence in a financial world characterized by constant change. Governments revise policies, interest rates fluctuate, political priorities evolve, economic forecasts are repeatedly adjusted. Through all of these developments, physical gold retains the same fundamental characteristics it has possessed for generations. The most experienced investors recognize that preserving wealth requires balancing opportunity with protection. Growth assets remain essential for long-term returns, but resilience also matters. Gold occupies a unique position because it contributes to resilience without depending on the financial strength of any single institution or government. Ultimately, the attention directed toward Treasury policy reflects something much larger than government borrowing alone. It reflects ongoing questions about fiscal sustainability, monetary stability, and the future direction of the global financial system. Central banks and global investors understand that these issues develop over years rather than weeks. Their actions often signal preparation rather than prediction. That is why every significant policy shift is studied so carefully. The decisions made today may influence capital flows, reserve management, and investor confidence for many years to come. And when institutions responsible for safeguarding enormous pools of wealth begin adjusting their long-term strategies, the rest of the market eventually takes notice. Every major bull market in gold has one thing in common. It begins long before the majority of investors recognize what is happening. By the time headlines start declaring that gold is unstoppable, much of the intelligent money has already positioned itself. That is why experienced investors spend less time chasing price and more time identifying the conditions that have historically supported sustained advances. The question is not whether gold can move sharply higher over a few trading sessions. Gold has always been capable of doing that. The more important question is whether the underlying forces that drive long-term bull markets are beginning to align once again. Looking across the global financial landscape, there are several developments that deserve careful attention. One of the strongest foundations for a lasting advance in gold is persistent uncertainty. Markets function best when participants have confidence in future economic conditions, government finances, and monetary policy. When that confidence weakens, even gradually, investors naturally begin searching for assets that are less dependent on promises and more dependent on intrinsic value. Gold has filled that role throughout history. Unlike financial assets that rely on earnings, debt repayments, or policy decisions, physical gold exists outside the credit system. It does not require a government to remain solvent or a corporation to generate profits. It simply represents stored purchasing power. That characteristic becomes increasingly valuable whenever uncertainty spreads across multiple areas of the economy at the same time. Another factor supporting the long-term outlook is the continued expansion of global debt. Governments, corporations, and households collectively carry debt levels that would have seemed extraordinary only a generation ago. Servicing that debt becomes more difficult as interest expenses rise, placing pressure on public finances and economic growth. While debt alone does not guarantee higher gold prices, it creates an environment where policymakers often face difficult choices between supporting growth and maintaining monetary stability. History suggests those choices rarely produce simple outcomes. Gold also benefits when investors begin questioning the long-term purchasing power of paper currencies. Inflation does not have to spiral out of control for this concern to emerge. Even moderate inflation sustained over many years steadily reduces the value of money held in cash. Investors understand that preserving purchasing power is just as important as generating investment returns. At the same time, physical demand continues to play a significant role. Jewelry demand, industrial applications, private investment, and official sector purchases all contribute to the balance between supply and demand. Unlike many financial assets, gold is supported by both investment demand and real-world ownership. This creates a market that responds not only to speculation, but also to long-term accumulation. Mining production introduces another important consideration. Discovering new high-grade deposits has become increasingly challenging. Existing mines naturally experience declining ore grades over time, while environmental regulations, permitting requirements, and rising production costs make developing new projects more complex and expensive. Supply growth, therefore, remains relatively constrained compared to many other commodities. This does not mean shortages are inevitable, but it does suggest that significant increases in demand cannot always be met quickly through additional production. When demand strengthens while supply remains relatively stable, prices often respond accordingly. Another signal worth monitoring is investor participation. During the early stages of major precious metals bull markets, institutional participation often develops quietly. Large investors typically build positions gradually rather than making dramatic purchases that attract unnecessary attention. Retail participation usually arrives later once prices have already established a